Hey everyone, Ryan Bolton here. I am a mortgage nerd. I work for Patriot Home Mortgage, and I'm licensed in the states of Utah and Nevada. And today is your mortgage market report. The first thing I want to talk about is the MBS. This is the mortgage backed security market. This is what affects interest rates the most. And right now we're seeing about a 5 basis points improvement from today. We saw kind of a big loss on Friday, so we're getting a little bit of that back. But overall, last week, I think we were down only 16 basis points for the entire week. So getting five of that back. I mean, that's basically an 11-point drop within the last 6 business days. That's pretty low, but we would like to see that number be more in the positive because that'll help interest rates go down. But at the time of this recording, we're at 5 basis points. There's a bunch of different reports coming out this week that might change interest rates. I think maybe for the better, depending on how these reports come out. And you always see their expectations will come out. It's how close they hit that expectation when you see movement. So if they're way off, that's when you see the market kind of react. But when they're a certain number, you're going to see. So I think there's a little wait and see. That's why the bonds have been kind of flat. They had a couple auctions last week. We just kind of in the stuck kind of wait and see pattern that we've been talking about. But I think there is some reports this week that should actually help interest rates go down a little bit going forward. The next thing I wanted to mention was the unemployment numbers came out Thursday. So I kind of looked at those a little bit closer. Employment fell by 15 points, which is the weakest level since August of 2011. That's about 13 years ago. So that's kind of a big drop during that time frame. The unemployment category, those that expect the unemployment to rise, actually rose by 8 points. So they actually think it's going to get a little worse when it comes to employment numbers. And that's really kind of one of the tools, or I shouldn't say tool, but one of the repercussions of interest rates going up. And that's why even Congress was so concerned with the Fed raising rates so quickly, is there's usually an unemployment surge, or usually there's a drop of unemployment during that time as well, which unfortunately that's just kind of an unintended consequence, or maybe even intended to help with inflation numbers by actually have job numbers get worse, like unemployment actually increase because it just has less money in circulation, which helps supply catch up, which just kind of gets the money get spent into other places. So then it's doesn't have this big surge of money that we saw during the COVID pandemic, government spending, all the things we've been talking about on the show the last couple of weeks. So the crazy thing is the unemployment numbers really didn't get worse. Now they're starting to. And I think some of that is savings also was really up. During the pandemic, people couldn't spend money on concerts and shows and going to restaurants and doing certain things. So kind of naturally savings rates kind of went up a little bit. There were just less places to spend the money. But then when inflation kicked up so quickly, that savings just got evaporated because everything that was able to spend money on just went more expensive. So certain industries went down because people weren't spending money there, while other industries was where money was going. So our savings rates have gone down like crazy from the very high point of the pandemic. So unemployment numbers are also starting to kick up with that as well. Here's also a quote from the University of Michigan. This 8-point surge in unemployment expectation is unusually large, about double the size of the typical month to month change, suggesting that consumer views on labor markets have materially changed in May. This is coinciding with a little bit of a weaker jobs market, the unemployment rate rising by 1%, weaker claim numbers. Maybe we continue to see this trend as the job market does get a little bit weaker. So it's interesting. That'll definitely be something to watch, is the expectation that unemployment's going to go up. But I remember seeing this report that they were really expecting it to go up last year a lot more than it did. So maybe now it's like, okay, what's supposed to kind of happen took longer, which is part of trying to have these soft landings and just trying to correct things instead of having these crises or big crashes. So maybe it's just been delayed more than anything as we get a little bit closer to where those savings and people had reserve and had money saved up. Even businesses had some money saved up to maybe kind of keep things going, feeling like, okay, maybe we've gotten through the worst of it. Maybe we are going to start seeing things turn around. But the Fed also hasn't been able to lower the interest rate because inflation still hasn't gotten down to that target number of 2 or even the high 2% range. And so I think it's softer, but it might be lasting and dragging out a little longer than everybody expected. But it does seem like some of these things were intended to be softer. But having the expectation change that much is definitely a surprising part of this report I saw. Last thing I wanted to bring up today is the New York Times. Let me scroll up to that little part of my little notes here. The New York Times had a very interesting article. They have a new calculator on their website that is buying versus renting. So it allows you to put in these scenarios on whether it's better to buy or rent. But what I found was how they put the calculation in, how they encourage people to buy or rent showed that you would save 133,000 over the next 10 years if you rent. But when I dove into how they came up with that in their calculator, there's some glaring things to me that were wrong. They put in 500,000 as the home price. They compared it to 2,000 in monthly rent. Okay, 2,000 is not going to get you a $5,000 home. So right off the bat, you're already kind of favoring showing that rental is going to be better. The other thing I thought was really interesting is they only had rents go up by 3%. Now, anybody watching this video, when was the last time your rent only went up 3%? We've seen big jumps over the last 2 or 3 years. So that seems a little low as well, that the rent wouldn't go up quicker over 10 years than 3%. They also had home appreciation only at 2%, which that might be that's still a little on the low side. So seems like everything on the numbers was kind of skewed in very conservative numbers or aggressively looking at saying you should rent instead of buying, because over those calculations over 10 years you'd save 133,000. Also, they had a 1% per year repair cost on the home. Now, over a 10-year period, that might average out to that, but I feel like that number's a little high. From my experience, maybe you can correct me if I'm wrong. I mean, when you have major expenditures, that can be no expense for a year, and then all of a sudden a bunch of things break and then nothing for the next 7 years. So, I mean, it obviously is trying to take a snapshot over a 10-year period, but it seems like it's very much biased towards the rental and not really real world. So, what I did is I went in there and corrected kind of what I thought were the actual true numbers, actual appreciation, actual expenses on the house, actual increase in rents. So I did it like 5% instead of 3% because it just seems like it jumps more than just 3%. And after I did those little tweaks, just change the percentages to what I think is a little more real world, it changed it to saying, okay, now you should buy in this scenario and you would be 254,000 more positive over the next 10 years. So the New York Times had 133 positive if you're a renter with their numbers. When I adjust it to what I think the numbers really should be, or at least a lot more, it's still a little on the conservative side. It switched it to 254,000 positive for the owner. So, I mean, it's cool. This is a cool calculator on New York Times, but I really found that the numbers they used were very skewed to the renter side, and even then, it's 133,000 over the next 10 years. If you tweak it a little bit, buying a home shoots up dramatically, like dramatically over that 10-year period. And for me, it's that consistency of the payment. It's the tax benefits, which I don't even know if that's factored into the calculator. It's the appreciation on the home way outweighs over a 10-year period when it comes to renting. And I think for me, the biggest thing is the locked in payment. You know, knowing what your payment's going to be versus rental, it's going to go up every time you go to renew. Like anybody that's renewing your lease right now, are you really thinking it's going to go down? Do you even think it's going to stay the same? Everybody I talked to said, I don't know what the rents are going to go up. It's probably going to go up. If the landlord can charge more and their cost basis went up and everything else went up, that's how they make their money on that investment. A lot of them are going to go up. Not everybody. Some people may be set with their mortgage, so they don't have to charge their renters anymore. But most cases, I think most people are very aware that their rental payment's going to go up. So I don't know if you saw that report, but I thought it was pretty interesting. And I thought it was just really skewed when I thought, well, what if we adjust these numbers just a little bit? And it's amazing how quick it switched. I mean, we're talking 133,000 negative to $254,000 positive by simply changing the the cost of rent going up and changing the appreciation on the home by like a 0.5%. Just blown away at how quickly it switched, where it makes more sense to buy a home. So love to talk to you about your particular situation. If you're looking to buy a home in St. George, in Utah in general, I do the whole state of Utah and Nevada. Love an opportunity to work with you and run some actual numbers for you on when it is better. But I really think it's better to buy, especially over a 10-year period. Now, short term, sure, rentals make sense. There's going to be times where you need to rent when you're relocating, and just there is going to be cheaper housing expenditures renting than buying. But the sooner you can get into home ownership, even if you got to be further out of town or got to team up with family members or cousins or roommates or something like that, the sooner you can get into home ownership, I think the better off you're going to be. So appreciate you watching the video. Let me know what you think. Like, subscribe, comment below, and we'll see you on the next video. Thanks, everybody.